All right, well, good morning, everyone. My name is Ian McGriff. I'm the Vice President of Marketing and Business Development with ACT Research, and we are here today to conclude our conversation or a series of discussions related to the commercial vehicle market. Over the 4 weeks prior to the holiday break, we launched a series of videos between Kirk, Mann and Steve Tam discussing various aspects of the market, specifically equipment allocation, emerging technologies, TCO, and the economy. And our objective today is to, kind of conclude and wrap up that discussion that we had and kind of dig in a little bit deeper about some of those key areas of interest in those topics, and talk about how data can help you strategically plan for your business over 2023 and beyond even. So our objective today is to do just that and to dig in. So without further ado, I'm going to kick it over to Steve and to Kirk, and they're going to jump into this conversation, I believe, starting with the economy. So Steve, Kirk, it's all you.
All right, thanks, Ian. So,
thank you,
hi, Kirk. Good to see you again, even if it's virtually this time.
Absolutely, good to see you as always, Mr. Tam.
Well, thank you for the opportunity here and for putting together and kind of being the brains behind this series. And as Ian said, today's kind of a little bit deeper dive. We want to take some of the elements that we've examined in the previous sessions. Share an update with you because things have changed as we put those videos together, and really kind of more importantly talk about, okay, how can you leverage that data, that information, that analysis into something that, hopefully, quite honestly, that you can monetize, right? That you can incorporate into your strategic planning and, make the bottom line better tomorrow than it was yesterday or today. So the other thing that I wanted to comment on before we get started is, as I go through some of these different areas, we'll call out those uses, but we want to look at some of the different market segments too. We don't want to just focus on the over-the-road freight markets, right? We want to look at vocational markets, or at least consider them. Think about what's happening in light and medium duty, as well as even with trailing equipment. So just fair warning, if I don't do that and you have questions about it, you can feel free to chat your questions to us, and we will field those at the end of each of the sections. And I'll call for questions when we get there. But let me shut up and let's just jump in with both feet and start kind of talking about what we see in the economy and what's going on. Kirk, the audience might remember, especially from the earlier part of 2022, there was a lot of debate about what is a recession and, is the economy in one? And, to refresh folks' memories, we did in fact have 2 quarters of negative GDP, first and second quarter of 2022. I think the first quarter was about 1.5% negative, and I think the second quarter was about 0.5% negative. Third quarter this year went gangbusters with almost 3% growth. That's a very good year. And full year expectations, we're looking at something probably around 2% by the time everything is said and done. So was it a recession? Was it not a recession? It's interesting that the tagline that we've been using on a lot of the presentations that we've been giving as of late is, it was the best recession ever. Or maybe that's the way to think about 2023, right? Yeah. Because, I'll talk about our forecasts and our outlook for this year as we go through today's session. And unfortunately, I've got some not so good news for the audience. Now, let me preface that before I go any further by saying, we participate in the Blue Chip Economic Advisors GDP forecast. We're one of the Blue Chip 50, and I will say that we are one of the most bearish of that group. Not the most bearish, but we're probably down in that 20% quartile, right? So first quarter, we're looking at negative 2% GDP probably for this year, and probably not much better than that in second quarter. We do improve in the third quarter, but we still don't quite drag it over that growth goal line. And then by the time we get out to the end of next year, we see the situation improving. Now, two things. First off, if you look at the full year of 2023, our call, even though we're bearish, is minus 0.5%, right? So that's pretty shallow as far as recessions go. It's also relatively short in duration. And then the other thing that I wanted to point out is, with the revision, the upward revisions that we got to the Q3 GDP numbers, we're taking another look at our GDP forecast for 2023. And there is, I think, a pretty good possibility that we could see 2023 being flat relative to 2022. So those numbers that I quoted are what we have in play right now, but we do have the opportunity to forecast on a monthly basis, or at least review those forecasts on a monthly basis. So as conditions warrant, we might need to ratchet up there a little bit. So that's kind of the top line, the big picture, if you will. Not a bad place to be, quite honestly. Yeah, we would all love to have stronger GDP growth than that, but think about what we're measuring against. We've had some pretty strong output, not only from a macroeconomic perspective, but specifically within our industry, as we've rolled through the last couple of years. Yeah, everybody wants it to be better. Everybody wants to continue to see that growth curve go up and to the right, but the reality of the situation is that's just not a sustainable trajectory. So, Kirk, just shut me off at any time if you want to chime in. Otherwise, I'm just going to keep monologuing here. So,
Yeah, no, I look, Steve. I think, and you were right. You're sort of covering the macro side of this equation, and so for us and for our customers, the question becomes, how is this going to have an effect on our dealerships and their customers? And certainly that word recession's been bouncing around quite a bit lately in the media and in financial circles. And to your point, we've had 2 quarters that would indicate we're in a recession. But the struggle that you have in this conversation is that it's a little bit of a mixed bag across the spectrum of OEMs, dealers, and end user customers. OEMs are still playing a little bit of catch up, and we know that emissions requirements for 2024 will drive as much pre-buy activity as possible. Our dealers will face potential downswings the same way they have for a very long time. They'll focus on service and parts. They'll keep their customers running in an aging U.S. fleet. I mean, with the absence of production in some areas, there's certainly going to inevitably be a little bit of aging among the U.S. fleet. For end user customers and for dealers, frankly, managing working capital becomes very important during these times. And I think a recent article in the Monitor highlighted a few things for a New Year's to-do list that were pretty good. And the first thing was, staying in tune with the economic developments and the environment. And, that's it. People do that. We wake up every day, we look at the news, we read the newspaper, we get online and we see what folks are saying about the macroeconomic environment. But there are steps you can take to recession-proof your business, and the principal way that any of us do it is by finding new opportunities, really taking advantage of situations where maybe someone needs help and you can be a solution to that. And so really working to find new opportunities is the way to recession-proof for all of us. And then optimizing your working capital. If you're in the trucking business, you can use factoring, leverage factoring to do that. And any supply chain finance, asset-based lending products and solutions are helpful in sort of evening out that cash flow over time. We have customers, OEMs, dealers, end user customers that simply refuse to participate in recessions because they are constantly, sourcing new business opportunities, driving greater efficiencies in their business and keeping their powder dry. That is, they're keeping their expenses low, and they're finding less expensive ways of conducting business. So there's always going to be these ups and downs in the general economy and in the transportation sector, but there are ways of getting through it and coming out even better on the other side.
Those are all excellent points. And I particularly want to underscore the one about, if you want to call it variance or diversity, just the difference, Kirk, what am I talking about, of the various segments, right? And even within segments, there's a lot of variation, right? What is average? You take all the abnormal and you throw it together and you normalize it, right? And so not every trucking company, not every customer, not every dealer, right, performs the same way. Even the economy is like that. A great example, right? If you just look at the consumer, who makes up 70% of the economy and supports so much of the business that goes on in the trucking world. If you look at how we as consumers spend money, it breaks up into three different things, right? You have durable goods, which are, refrigerators and stuff like that. You have non-durable goods like clothing, for example, and then the whole services side of the economy. And we've seen a lot of give and take, a lot of push and pull as we've recovered from COVID in those areas. Right now, the most recent numbers, the non-durable stuff, you hear the reports, right? You hear the big box retailers of the world saying, oh my gosh, we've got too much inventory. We have to discount to get rid of stuff. Non-durables are down on a year-over-year basis, and pretty meaningfully. Durable goods seem to be holding their own. The automotive market's not an 18 million unit market right now, but it was 13.5 for the end of the year and for most of last year. Not a bad year. Services, they're up 3 or 4% right now. So, for those companies that are not hauling stuff around inside their trucks, but providing, services to us, there's a lot of opportunity, to your point about, looking at your business model and how you can adapt it. Don't forget that portion of the economy. It's not insignificant. So
that's right. And look, I had a former boss who, during a particular downturn, I think it was 2001. He was very adamant to remind us that we still need food, we still need clothing. And so those things are still going to come by truck. And a lot of the medications and just the daily deliveries that we're getting nowadays on our front doorstep are still going to be there. We may not buy as many books, or we may not, there may be certain things that we trim back on, but the fundamentals are still going to be there. And we're still going to need people to deliver that fundamental value to the market.
Absolutely. So I want to wrap up the kind of the overview on the economy just by, thinking about how our audience can use it. And I think, the forecasts, in my mind, they sort of underpin all the assumptions that a business is going to make about what their year is going to look like, or what their plan is going to look like, right? So it's going to drive decisions on sourcing. You already mentioned the investment piece. It tends to be a little bit more strategic in nature than tactical. And I know we're trying to talk about the tactical here, but you already made the excellent point again that, you need to pay attention in the short term. That breakfast for your head, right? You get it up and turn on the newspaper, or turn on the radio, or read the newspaper. Things are changing on a daily basis, and you have to stay in touch. You have to stay in tune. And so that really, I guess, in my mind, is the key. So, Ian, do we have any questions from our audience on the economic portion of the presentation that we've done so far?
We do. And ELFA convention keynote speaker mentioned that the next decade would be the most disruptive in history. How do you, Kirk, as a lender, and then Steve, with the conversations that we're having with our customers, that guide or talk with our customers about how they can navigate through this climate?
Yeah, so thank you, Ian. I would say that for our OEMs, dealers, and end user customers, this disruption is really centered around clean technologies, actionable intelligence, predictive and prescriptive software analytics, business optimization, things like routing, software, driver safety. Even you've seen some of the reports on computer vision tools for unloading and unloading a tractor trailer. Amazon is doing it in record time these days by using that tool and basically making everything along the supply chain and in the ecosystem of the end user a lot easier and more efficient. So, you know, look, lenders are certainly positioning resources to address these issues. One example here at Mitsubishi AC Capital is, you know, we began evaluating partnerships with organizations that can consult with dealers on charging infrastructure, building the infrastructure, installing the equipment. And these partnered programs make it easier for everyone to execute on this transition. So we built out a mobility solutions platform that has been dedicated for the last 4 years or so to finding and discovering ways that we can serve that need as things become disrupted. I'm not sure I love the word disruption. I think it's just more of a transition, and it's going to come over time by necessity. There's no way that we could just convert, you know, every single car, truck, and bus in the U.S. to be a battery electric vehicle or anything else for that matter, because the infrastructure just simply isn't there. But it's coming, and it will take time, and we will get there. But we want to serve, you know, we as lenders, and most of the lenders that I talk to, we're all in the same boat. We're serving the ICE need, the internal combustion engine need, and we're also serving the need for transition. So I think that's kind of how things are going to play out. It's going to be a marathon, not a sprint.
Yeah, absolutely. You know, in my mind, I guess the disruption, I think you characterized it well, Kirk. It's more of a transition or a morphing, right? From an economic perspective, you know, there's only two ways to grow the economy: consumption or population, increase in population, and improve productivity. And that's ultimately, I think, where we're headed. Obviously, the clean tech piece or the clean piece is a significant consideration. That's not going to grow the economy, though, quite honestly. These things that we're talking about are probably not going to change demand for commercial vehicles. They might change when the demand gets realized, or they might change, you know, what actually fulfills the demand. That's the transformative piece. But at the end of the day, you know, this market's gonna be here and continue to serve the economy. So,
no doubt.
Let's go ahead and move on, because we've got quite a bit of material to cover, and I don't want to bore everybody, you know, with economics all day. Although that having been said, I do have one piece that I'd like to touch on, and that's just kind of the freight component, or if you will, activity, because I guess we want to include the vocational folks, just to kind of level set, you know, where we see things happening. So regardless of the debate that we have about whether or not the economy is in a recession, freight is absolutely on the decline. No questions, no ifs, ands, or buts. And we see that as a pervasive theme throughout the 2023 timeframe. Now, the good news is very similar to the broader economy, right? Manufacturing is slowing down, but it's coming from very high levels, okay? And it's not likely to drop, the trough of this cycle is not likely to drop below the previous trough that we've seen. So when we talk about freight being down, we're talking about, you know, year-over-year declines of probably less than 5% as we roll through 2023. That would be a year-over-year comparison on a monthly basis, right? And then that actually starts to disappear or dissipate as we get out toward the end of the year. So just kind of giving folks a sense of where we see things going. And then, of course, transitioning into growth or positive frame in the 2024 timeframe. And that's important because, again, you know, you need a certain number of trucks, a certain number of trailers to haul whatever, either freight or economic activity, be it services, that the industry is trying to handle. So that kind of underpins our outlook of the economy and of the unit forecast for equipment, which we'll talk about a little bit further into the webinar. Following what happens on the freight side of the business is what happens with the dollars and cents associated with freight, right? And I'm sure everybody's read about, oh, the spot freight rate market has just fallen apart, right? It peaked in very early 22 at stupidly high levels. At levels that were so high, it was attracting an awful lot of folks into the industry who had never even driven a truck before, never owned a truck. Nothing wrong with that, right? The trucking segment abhors a vacuum, and we'll fill it up the best way we can. So of course, the ramifications of that echoed throughout the industry, and we'll talk about, for example, used truck prices maybe a little bit further in. But things are settling down now; they're shaking out, and very similar to what we expect for the actual, hard movement of goods. A similar expectation for what's going to happen with rates. They actually started declining quite a bit sooner because so many people were jumping in and trying to participate. And they've been negative really since the beginning, almost the first quarter of this year. And we think they'll stay that way probably through, well, for sure through the first half of 2023, and in all likelihood, probably into the fourth quarter. But then, as this equilibrium, right, as the balance between equipment and work comes into balance and then goes the other direction, capacity will get scarce again in 2024, and we'll see a repeat of this cycle in this very cyclical nature. Right. Then you have to take the kind of the logical extension of that. Rates mean one thing, but how do the trucking companies do? How do the carriers do? How do the equipment users do in terms of managing their costs? So if we look at profitability, we tend to tag the publicly traded truckload carriers as a proxy for profitability within the trucking world. They've enjoyed the best profit margins in the history of the industry in the most recent year. They'll probably finish 2022 at a 7% net profit margin. Historically, that's 4%, maybe 5%. With the downturn that we're expecting, so slowing freight and slowing rates, by the time we get out to the end of 2023, that profit margin will probably have diluted to somewhere around 5.5%. But still, that's a full 100 basis points better than their pre-COVID historical average. So still a very profitable industry, still plenty of support for demand for commercial vehicles. It just goes back to that old ATA saying, right? And Kirk, you kind of said it too, but if you bought it, a truck brought it, right? This economy is built on the back of trucking, and there's just no two ways about it. Yeah. I guess from my perspective, why that's important, you're really starting to drill down on the end markets when you're looking at freight, when you're looking at construction activity, any of the services activity. But being able to have a sense of where that market is going, it also explains kind of where demand for commercial vehicles is going. And if an equipment buyer, an equipment lessor can get ahead of that curve, beat the competition to the punch, so to speak, there's an opportunity to parlay that into an advantage, quite honestly. And it doesn't matter whether you're looking at the volume of shipments, the number of roads or miles of roads constructed, whether you're looking at the rates, whether you're looking at profit margins, all of those things are informative as to the direction of where stuff's headed. I see Kirk.
Yeah, Steve, I'm gonna jump in here real quick. You hear a lot about the desire for from some industry people that want us to kind of look like Europe, in that everything is real time and you order your truck online and it just shows up on your doorstep, or whatever. I got to tell you, I think all it will take is one OEM that says, you know what, I think I'll go grab some market share today. And they just start manufacturing, stock units, as we have always done here in the US. And our economy is pretty dynamic. I'm not saying it wouldn't be helpful for us to know what's coming through the supply chain and having perfect visibility to what, raw materials are available and how much manufacturing capacity we have, and subsequently how many trucks we can build. But I just, we live in a slightly different society, and I can't imagine that someone won't say, I think I'll still get some more market share today, and stock some inventory for people as they're moving forward. But the other thing that I wanted to mention, Steve, is, when it comes to what's going on in the freight market, and whatnot, we pay very close attention to the ACT dashboard, the ACT Research dashboard for Class 8 trucks. And, it has a number of key metrics on it. And you see red, green all throughout that chart. And we pay attention to that. We look to see when the inflection has occurred. And when that inflection happens, we know kind of how to resource our business. If it's a downward inflection, then we know that we're probably getting ready to need to apply, resources into that environment where we're helping customers get over a hump. Maybe it's an extension of 30, 60, 90 days, whatever it is. We certainly saw this in COVID, during COVID in 2020, when we needed to help people get over a hump. And it was the most incredible thing I've seen in 32 years. We helped people, as many people as needed it and wanted it. And literally the vast percentage of people that said, yes, I would like some help right now. The vast percentage of people picked up payments in a normal schedule, and after that little bit of period of help, and have never looked back. But that took an enormous amount of resource for us, and that was maybe worse than a normal recession because no one really knew what was going to happen. In normal recessions, where you don't have a pandemic sort of hovering over your heads, you kind of know what to expect. And so from a resourcing standpoint, we're engaging with customers and helping them work through those difficult times. We kind of know how much we need, but during COVID in 2020, that need was exacerbated remarkably. And so we were having to train some people to have upfront conversations, and then drive good solutions for our customers. And I'll tell you that period of time, 2020, was very impactful to me in terms of the dedication of the people in this industry, the end user customer. They want to keep going and do well. And so it helps us when we look at that dashboard. It helps us begin to resource the need ahead of time so that we can get them over a hump. And we have people that are standing by ready to have that conversation. That happens with most lenders. I mean, most lenders are doing the same thing. They're just trying to make sure their customers get over the difficult moment.
Yep, I think that's a great piece of learning that the industry experienced over that cycle. The lenders don't have any need or desire to own trucks, and we need to keep them in place and keep them rolling. And you can give a hand out, help them up, and that, I think that worked out very well for everybody involved. So. You kind of play right into the next area. Oh, I guess maybe I should ask Ian if we have any questions. I was going to move to the next area, but Ian, do we have any questions on freight or activity or freight rates or that sort of thing?
No, not at this time. No questions on freight. Let's go ahead and transition.
All right. Yeah, let me go ahead and move then. One of the things, Kirk, that you alluded to was, the inability to get trucks and the supply chain constraints that we had, and that whole rigmarole. And just to put some numbers on it, if you look at 2021 in the U.S. market, our new truck sales were about 240,000, which generally is considered to be a pretty decent year. I'm sorry, new replacement was 240. New truck sales were about 225. the challenge is that coming out of COVID, we had 6% GDP. So we all of a sudden had all this additional freight and activity that we needed equipment to process, to deliver, to handle. So at 6% GDP, that's probably about 70,000 incremental units we needed in the fleet just to handle that work. So that put our shortfall, you know, we underproduced, if you will, or under replaced by almost 85,000 units just in 1 year. And that's just Class 8, right? That doesn't include the duty side. That doesn't include the trailer side. Now the shortfalls weren't as bad in those areas as the Class 8 side of the business. But holy cow, that really put us in a hole. And you talked earlier about, you know, the fleet aging. Well, if you under replace, that's a natural. You're having to hold on to your trucks longer. You know, you're extending your trade cycle, if you will, and so your fleet's aging, and of course with that comes, you know, higher maintenance costs and more frequent incidents of needing maintenance, and you know, all the bad things that you try to avoid, that you've planned so hard to try to prevent or stay away from. So pretty crazy that we were in that situation. You know, with the forecasts that we've got in place right now, we'll still be dealing with a bit of a shortfall in the 2023 timeframe, but we should just about have that fleet right-sized by the time that we get out to the end of 2023, get to the beginning of 2024. And again, point out that's the big picture, right? That's at the macro level. For larger fleets or for fleets that have relatively short trade cycles, they're the most frustrated right now because, you know, just like everybody else, you know, they're getting trucks, but they're not getting everything that they want. Some of the private fleets that are out there who have longer trade cycles or don't trade as much or as large of a percentage of their fleet on an annual basis, even though they're still not getting everything that they want, they're systemically or programmatically more well-positioned to handle that change. Saying that a different way, their fleet just doesn't age as fast, if you can kind of wrap your head around that, I guess, right?
Right.
Yeah.
Right. Yeah, Steve, I think it was September of 2021, and I'm going to cite this incorrectly, I think, but I believe it was Trucking Info that reported just for the month of September of 2021, we were about 11,000 Class 8 trucks short on the production side. But that was against the backdrop of big GDP. That's coming down a bit. So capacity isn't going to end up being constrained as much until it is, right? I mean, we all know where this pendulum swings, and it ultimately swings back to, excess supply, or at least something equal, an equilibrium.
Yeah.
And but just to sort of give you a little bit of real world flavor for what was going on at that time, I was having a conversation with one of our dealers one day, and he said, "Kirk, you wouldn't believe it." He said, "I had a customer come in and he said, I need to repair my truck." And the dealer told him, he said, that's not in your best interest. He said, "It'd be great for me and the income that we could derive from it, but it's not in your best interest. You ought to be getting a new truck." He said, "Okay, well, sell me a new truck." And he said, I can't. I don't have a new truck." And he goes, "Okay, well, sell me a used truck." And he said, I don't have what you need. And the guy said, "Well, then repair my truck." You know, so you're in this funny place of trying to be the very best partner you can for your customers, but the dynamics of what's happening in the market kind of constrain that a little bit, and your customer just needs something that he can serve his customer with. So it's interesting how things play out in the market during these different times.
Yeah, it is indeed. And, you know, I guess if there's good news, it's that we've made progress on the supply chain front. If you think about where we were a year ago, there were literally hundreds of different parts on the watch list. And, you know, we would liken the exercise to a game of whack-a-mole. you never knew what the next problem was going to be or when it was going to come up.
Yeah.
And you'd think you'd have it solved and it'd come up again and bite you. And, today that list is probably down in the dozens of parts that we're having to keep our eyes on and track pretty closely. I think, the best thing is there aren't very many known unknowns. We know what the problems are. We know where they are, and the system is working to get them taken care of. But starting at the top line, semiconductors, they're better, but they're still not good. It's still an issue. If I look at some of the other parts, tires are in short supply. Now, full disclosure, tires are almost always in short supply. But a lot of our swing capacity, our flex capacity, comes from Asia or from China. And so with everything that's going on right there, with respect to COVID, that represents a risk or a potential challenge for us. But things like filters, something as innocuous as a filter, still a rough time in that industry. Brake drums, engines and blocks and transmissions and clutches and windshields, all of them.
Yeah.
And it's not across the board. It's here and there, and it can be vehicle specific. It can be application specific. It's just
right.
a mosaic, if you will, of challenges. And that's gonna lead us to a situation where we are going to be, for the most part, in allocation throughout all of 2023. Now, it will get progressively better as we go. And the other thing that's interesting about allocation, the one comment that I wanted to make on that was that it's fluid right now, right? So maybe for customers who aren't doing as well, whose end markets are challenged, maybe they're making a decision to cancel some orders that they've got on the books. But that's freeing up capacity for somebody who's, at least up to this point, not been able to get all of the equipment that they want. And so at the top line, we don't see any difference in demand. It's staying the same. But underneath, if you look at what's going on, you see this, this machination of things moving around. So
yeah. And some of that, red tagged inventory or built shy inventory is really it's coming around. They're getting the parts that they need. They're completing the units, and some of that will certainly will experience in 2023. So it's come from a very challenging place to something that seems to be a little more tenable, but it depends on what vehicle you're talking about. To your point, what the application is, who the OEM is, what parts manufacturer suppliers they're using. It all plays into it, right? But I do think by and large it's getting better, and we're going to see I think OEMs having a pretty good production year in 2023. And I wonder, to your earlier point about capacity and demand, I wonder if we don't sort of, find equilibrium faster than what we thought we might, as we see developments across the spectrum here in 23. It'll be fun to watch.
I certainly wouldn't discount the possibility. We're starting to see year-end data, December data trickle in right now for the industry. And, there's always an interesting year-end dynamic, right? We always have that hockey stick curve in sales. Well, in order to be able to sell that truck, you had to build it, right? And, we don't have trucks sitting around in inventory that we can just sell. Typically, those are all spoken for. And so as a result, we probably saw a corresponding uptick in production in December. And I think your comment about red tag trucks and getting those processed and cleared is spot on. I think there was a very strong incentive to be able to do that. At one time, at one point, probably at its worst in this whole situation, we estimated that we had 35,000 red tag Class 8 trucks. That the OEMs have whittled that down. I think today we're probably getting to be pretty close to normal, whatever that is. You know, you see ebbs and flows, right? Obviously. But I think that we're probably, if I had to put a number on it, fewer than 5,000, probably fewer than 3,000 red tag trucks out there today would be my best guess. I can't be held to that number because we don't know, but you know, in terms of trying to check, I'd say that's probably not too far off. So. Yeah, you alluded to 23 production forecasts. I'll get to that in just a minute, but let's just check real quick in with Ian and see if anybody had any questions on replacement, on you know, what's going on with the supply chain constraints that we talked about. Any questions there, Ian?
No questions on that end. So we'll again encourage our participants, you know, if you have questions, go ahead and submit them. Don't wait till the section necessarily. Just go ahead and start submitting those questions as you have them.
Yep, fair point. Yeah. So given that, then let's go ahead and kind of turn our attention to another facet of the new truck market. I only wanted to make a few comments here with respect to the data that's out there, and you know, how folks can parlay that into meaningful intelligence, I guess, or strategic planning, however you want to think about it. If your audience has been watching what's been happening in the industry, we have had very, very solid order intake for the last 4 months. At the North America level, September, we had an all-time high for record intake in the history of the industry at more than 55,000 orders for the month. It dropped into the 40,000s in October, and then in both December and January, the January preliminary numbers, we've seen, you know, units in order intake of in excess of 30,000 vehicles. And again, that's a Class 8 number for you. It's interesting.
Big numbers.
Very big numbers, yeah, obviously. It's been a real challenge with the disruptions that we've had to gauge the level of true demand among the truck buying populace out there. The OEMs have been playing it very close to the vest because of the uncertainty that's out there, right? They're not sure about the availability of parts. They're not sure if they can get those parts, what the prices are going to be. And so it's difficult for them to set pricing for the trucks. The way that we interpret this strength in order activity is twofold. First off, the manufacturing world is getting increasingly more comfortable with some of those unknowns, kind of vis-a-vis the earlier comments that I made. So they are able to start pointing to a supply chain that's beginning to function and flow a little bit more cleanly, a little bit more clearly, a little bit more consistently. And subsequently, that makes it easier to put the pricing on there. But it also, the strong order activity also, I think, serves as a confirmation of how strong pent-up demand among truck buyers continues to be. Even with freight slowing down, even with the economy potentially transitioning into contraction, it all harkens back to that under replacement, right? We've got to get that fleet right aged, and the truck buyers, the carriers, the private fleets, doesn't matter who they are, because of the strong economic performance that we've had up until this point, are in a position, capital position, to be able to effectively right age their fleets. So strong orders in the current marketplace. The other comment is kind of a natural extension or natural outcropping of strong orders and the inability or the challenge to meet those orders, what we call backlog in the industry. So it's the number of orders that are sitting there waiting to be built. On the Class 8 side of the market, in the US, just for Class 8 tractors, about 180,000, 185,000. That's almost twice what we normally have in the pipeline. We typically have about 100,000 trucks in the pipeline. In the medium duty world, it's even more dramatic, right? We've got about 125,000 orders on the books for medium duty trucks. Typically, that's about 40,000, 45,000. So almost, well, actually, yeah, three times the number of typical orders on the books for the medium duty folks. And that's an interesting tidbit. I'll diverge here for just a minute. One of the things that we've seen is a strategy where the OEMs are favoring production of Class 8, where they have scarce parts, and deferring or making the medium duty buyers wait longer to get access to their parts. That plays into our forecast thinking for 2023, but we'll talk about that here in just a minute. But that's been a real challenge for the industry as we've worked through here. We talked through, the supply chain constraints and some of the specific examples. I was going to cover those here, but I moved them up a little bit so we don't have to talk about them again, other than to just say the outlook is for improvement, right? It's a positive outlook from that perspective.
Steve, you've in the past you've produced charts that sort of show this industry, the transportation industry, just continuing to grow year after year after year after year, and there in the segments may shift a little bit. Class 8 sleeper trucks may shrink a little bit because of all the warehousing building that's going on, but overall they continue to sell more and more and more trucks, right? Their share of that market may decrease, and certainly we've seen class 3 trucks really taking a mountain share of the market because of that home delivery aspect and online purchases. So we are definitely in for a little bit of an adjustment here, but it's not all bad news. We continue to grow this economy and this market, and I think that we are going to continue to do that for the very long term. So, I love understanding exactly where we are at today, because it helps us make decisions about, where we are resourcing people and processes. And ACT Research certainly helps us with that process. But I also am, I don't know, maybe I'm too optimistic, but I love to think about the reality of, where we've come from and where we are today. And we're in pretty good shape, but we have some things to work through, certainly in 2023 and 24, before we maybe get back to just extraordinary growth again.
Fingers crossed, right? We just love to chase those cycles. Yeah,
absolutely.
An interesting observation that you make, Kirk. We've been following or trying to answer that question of, how has the distribution of freight and work, not just freight, among different GVW segments evolved over time. And, absolutely each of the segments continues to increase in size, but the greater share growth is at the lower end of the scale. And I think that's just a reflection of the changes that we've seen in consumption patterns, in distribution patterns, in demographics, just in general. Case in point, if you look at the class 6-7 market, it lost probably, I'm going to say, probably 70,000 units out of that class 6-7, out of the total fleet last year. But 4-5 grew by 85,000. And I don't have the stats on 3, but I know there was a leak that went down into class 3 and probably down into classes 1 and 2 as well. The post office is a huge contender in that home delivery contest. So they're not going to cede any share willingly. So yeah, it's just fascinating to watch those dynamics. And so by looking at, this new truck market, this current truck market indicator data, you can answer questions like that. It really, from our perspective, we kind of think of it as letting you keep a finger on the pulse of what's happening, right now. And you're trying to figure out, are buyers demanding equipment, or, is their hair on fire and they're running for the exits and canceling orders and, everything's falling apart. Are the OEMs able to keep pace with demand? Is inventory tight, or are the OEMs keeping the lines running just to keep the lines running and pumping trucks out there into inventory? And each and every one of the answers to those questions has implications, for how you should be thinking about your business and how you should be responding to what's going on in the marketplace. So yeah, it's fascinating. I mean, we could probably have an hour-long webinar in any one of those questions or topics, but we're going to move along. So, A couple
Good
other,
idea.
yeah, a couple other areas I wanted to cover. I mentioned earlier in the webinar some of the craziness that we've seen in the used truck market, and your story, your anecdote, kind of alluded to that as well. Because we've been making and selling and delivering new trucks at below replacement levels, truck operators have been holding on to their trucks, which means we're not seeing the trades into the secondary market that we typically see. We do have trades, right? We just don't have as many as we typically have. And in a 6% economy like we saw, earlier, we can't even handle the growth. I mentioned all the new truck entrants that were coming into the marketplace because freight rates were so strong. So the opportunity to make a profit and improve their situation was a huge incentive, a huge draw. Just to kind of give you a sense, if we look at the average price of a Class 8 truck retail, right? This is a used truck. In April last year, in 22, that peaked out at over $100,000. Now that's an average that makes no regard for age, mileage, spec, nothing, right? And I can tell you that the average age on those trucks was about 80 months, and they had probably about 450 or 500,000 miles on them. So these are not gently used trucks. These are not new trucks, new used trucks, right? These are, now some of them were. I won't even tell you what the price is on a 2-year-old truck with less than 50,000 miles on it. It was more than that truck cost new. Let's put it that way, right? It was absolutely crazy. So you fast forward to today, and the conversation in the used truck industry, people are like pulling their hair out because they A, don't have trucks to sell, and B, the prices have come down so much. Well, that same truck today is still $80,000. The historical average price of that truck is $50,000. So from a seller's perspective, if you have equipment and you want to sell it, or if you are a dealer and you are selling used truck equipment, your prices are still very good, and the market is still from a volume perspective, from a demand perspective, doing pretty well. Now, could it be better? Sure, of course it could. Expectations, just like everything else, are that market's going to continue to soften as we roll through the year and we rebalance capacity, right? So time is your enemy in this space. If you have equipment, now's the time to be remarketing it. You might,
Steve, I'll give you some more proof of that statement. What you're talking about used truck valuations. We have a sister company that has been around financing OTR, over the road trucks, for a long time, back in the 50s. And we were having a conversation around valuation of a particular truck not long ago, and I think the truck was selling somewhere close in the neighborhood of about $85,000. And at one point, about 9 months ago, that same truck was selling for about $120,000. And so, and I looked across the table and I asked my partner in credit, what historically do you see that truck valued at? And the number was $45,000. So, it's been a crazy ride on used truck valuations, and that's been a struggle, I'm certain, for a lot of lenders. But we've figured it out, and we evaluate everything the same way we always do. But you have to acknowledge the reality of the situation, and that is capacity and demand. And people need used equipment, have needed used equipment in the last couple of years for sure.
Yeah, that's exactly right. And our audience might be scratching their heads, going, why are these guys talking about used trucks? Even if you don't own your equipment, you need to have, I think, an understanding, at least an appreciation of what's happening in the used truck market, because it's really one transaction, right? Whatever the value of that used equipment is when you're trading new equipment, it's gonna have an impact on that total transaction cost, and that subsequently has an impact on the kind of the state of the market. What's going to happen with the cost or the price of your transportation, whether it's the equipment itself or whether it's just moving freight or providing a service. And so it is an integral part, I think, of what happens in that whole kind of life cycle of a truck, if you will.
Mhm.
Ian, I'll check in real quick on questions for the used market or anything that since the last time we talked about questions.
Sure. This question is related to both used and new production, and in that they're basically asking when can we expect things to go back respectively to pre-COVID levels? What does that look like for pricing, for production, and when do we think we're going to get there?
Oh, ouch. That, in a word,
I
never.
think this is yeah. I was going to say, Steve, I think this is where we've seen "Take Me Home, Country Road." I don't see us getting back to that. I don't see it. I think it's going to be much different going forward, and we all need to partner with people that are thinking about this with us as we move forward. So yeah, pre-COVID. Yeah.
Yeah, I would say, the genie is out of the bottle. So that was a multifaceted question. So let me break it down just a little bit. With respect to valuations, either new truck prices or used truck values, particularly on the used truck value side, what we're seeing right now is what I refer to as an ever-increasing sine wave. So we'll continue to have cycles, but the peak of the next cycle will exceed the peak of the previous cycle, as will the trough, right? So prices are going to continue to go up. And that's predicated on the fact that on the new truck side of the business, that's more of a linear equation, right? We've had some dramatic price increases on new vehicle equipment, prices as we've rolled through the post-COVID period. Generally speaking, historically, when we have commodity surcharges, those price increases are given back or taken away, if you will, when the underlying commodity price returns to normal. We're not seeing that this time. Those prices are much stickier as we've rolled through the last 2 or 3 years. And then, if you think about what we've got coming down the pike at us, Kirk mentioned at the beginning of the call, we've got emissions mandates coming, not just in 2023, but also a federal EPA standard in 2027 that was just announced at the end of December. The final rule was announced. Both of those are going to add significant cost to the price of a new truck, and that's going to ultimately carry over into the secondary market. Maybe not one for one, maybe not dollar for dollar, but it's going to have upward pricing pressure on used truck pricing as well. So that's kind of the thoughts on the pricing. On the volume perspective, thinking just kind of about a normalized market, it gets interrupted also by what's happening with with emissions, and that was actually the next section that I was going to go into. So maybe that's a good time to transition, talk about our forecasts, and talk about the impact of emissions mandates on the forecast. So again, just to kind of bring people up to speed, if you look at the U.S. Class 8 market, we tend to look at it in 2 segments, in 2 buckets. We look at trucks, vocational trucks, and we look at tractors or over the road, both sleeper as well as day cab. And for the U.S. market, we think this year tractor is going to be about right around 200,000 units. And because of everything that we've talked about up to this point, we see that tailing off a little bit to next year. Right now, we're looking at about probably 180,000 tractors for the U.S. market for 2023. On the truck side, it's a lot more stable. The vocational markets don't fluctuate to nearly the same degree the freight markets do. So we'll probably be 60,000 this year, and we'll probably be awfully close to that, maybe just a little bit shy of that in 2023 is the current call that we have. On the medium duty side, if you look at this year, probably about 210,000 trucks are going to get produced, and that's classes 4 through 7 for the U.S. market. We actually see that increasing in 2023, probably 230. So we'll get about a 10% pop in trucks. The thinking there is, you remember I mentioned earlier in the call that the OEMs have been favoring what's happening on the Class 8 side, trying to maximize their profitability there. Well, as the Class 8 market slows this year, based on our hypothesis, that's going to free up some of those scarce commodities to go into the medium duty segment. And in addition, as the supply chain overall improves, it's relieving a bit of that challenge, a bit of that supply. So we think you have a little bit more stability in the medium duty market. You've also got a much greater exposure to the services portion of the economy, so you don't have the expected downturn as far as underlying demand is considered in the medium duty space. So that's another thing that causes the two forecasts to move in opposite directions. On the trailing equipment front, pretty stable market. We're going to be probably right around 190,000 drive-ins this year, and probably maybe 195 next year. So very, very stable market there. Same for refrigerated trailers. I called those two out specifically because they're the highest volumes and probably the most likely that are used by folks who are audience to this call. So. And then the other, so that's kind of where the numbers are. The thinking in terms of pre-buy, right? We have the California Air Resources Board, or CARB, has a standard that's supposed to go into effect, actually two standards that are supposed to go into effect at the beginning of 2024. One is the omnibus standard, which deals specifically with tailpipe emissions. The other is the Clean Truck Initiative. If you go back 3 years ago, we were expecting a much larger pre-buy in 2023 ahead of that CARB standard in 2024, because there are 17 states around the country that follow California's emissions lead and typically adopt early, if you will. Well, that's not happening this time. And so we've pared that expectation for pre-buy back. So on the omnibus standard, you've actually only got 5 of those 17 states who are going to follow California. And I think 2 of the 5 are going to follow, they're going to delay a year. So they're not actually going to go 1/1/24, they're going to go 1/1/25. So bottom line, you take all that and put it in the shaker. We had about 10,000 units of pre-buy in 23 ahead of that 24 California mandate in our forecast. That's probably not a bad number. I don't know whether that many will actually get realized. The solace is that even if they don't, I talked about how the composition of demand is changing in the backlog. If the folks don't pre-buy for California, somebody's waiting in the wings to snap up that order to take that build slot and take delivery of that truck. So regardless of what we see with respect to California emissions this year and pre-buy activity ahead of it, not going to have an impact on the top line, positive or negative. So, and then 2027 is too far away to think about. It's not certainly not within the window of strategic planning from a tactical planning. From a strategic planning perspective, I would characterize our expectations as 2026 being the mother of all pre-buys. I think we've shared that language maybe in one of our earlier webinar sessions, but we're looking at an incremental cost on a Class 8 sleeper of $20,000 to $25,000. So any truck buyer that has the capital wherewithal to accelerate their trade cycle and avoid buying that 2027 compliant vehicle is likely to do so. So fun times ahead.
Absolutely. It just means opportunity for all of us.
Well, that's a very good way to look at it. You just have to take the cards you're dealt and make the best hand out of them that you possibly can. Yeah.
That's right. That's right.
Ian, do we have any questions? Or are you going to make a comment? Sorry.
No, I was actually going to say, Ian, do we have any questions?
Okay.
Yeah, we have a question related to how are your respective organizations, ACT Research and Mitsubishi HC, working with their customers to help them, understand or help to achieve those long-term decarbonization related goals? What's the work that's being put into place, respectively?
Yeah, I mentioned this a little bit ago. We about 4.5 years ago, we initiated a mobility solutions platform here at Mitsubishi HC Capital, and the purpose of that platform wasn't to really do anything other than try to figure it out, right? I mean, we were working with new entrant OEMs, existing OEMs, our dealers, end users, upfitters, trying to get a sense of what the need was going to be and how many people were were on board with initiating this transition today. And what that means is, if a dealer is going to take electrified trucks, battery electric vehicles, then they're going to need a way to charge those trucks so that they can demonstrate them for their customer, right? So the first step really for us was finding ways that we could serve our dealer and help him or her with that infrastructure build, not just the infrastructure build, but the consulting that comes before that, which is really centered on who's the utility company we're going to be working with here, and what kind of bandwidth in terms of energy can we expect to come through the pipe from that utility company. And then, is that enough? And if it's not enough, what are we going to do about that? So what are the other things that we can build that will supply the need to that location? So it's really location centric. And that consulting, that construction, the actual equipment that you're building out at that location all needs financing. So we've developed solutions inside of programs with partners that we can facilitate that process for dealers. And we're probably not the only lender in the universe that has done that, but we've done that. And that mobility solutions platform has really positioned us in a number of ways. Number one, what can we practically do today to help our dealers and their end user customers to make this transition, but also what's coming? What's going to be available in the future, and how can we plan to rally around that from a financing solution standpoint? I'll give you one example. It's going to be critical that companies understand that their utilization of that truck and the battery and the type of battery it is impacts the ultimate, use of that battery. It may be extended use, it may be short-term use, and you have to know when should you lift that battery out in terms of optimizing its performance, and then replace it with another battery. And that's largely a function of the application and the geography and a whole lot of other factors. But we've visited with partners who have the ability from a software analytics standpoint to look at that battery, understand the chemical compound of it, and then estimate its useful life. Now, and so what does that look like for the end user customer? Well, it probably looks like something like a subscription to a battery manufacturer or with a software analytics provider. And that subscription is just renewable. And when the battery needs to come out and we're optimizing the environment that it's in, you put another battery in there. So just one example of how some of these new financing solutions are being built. And it's all keeping in mind the ultimate efficiency of operation for the end user customer. Anytime we and our dealers and our OEM partners build out something that provides value to the end user, we've done a good thing, and we've helped each other. So, I mean, look, I would love a world where our dealers and our OEM partners and us and our upfitter partners could build sort of a business in a box for the end user. I mean, that's going to require some complexity, and we'll probably have to keep it vanilla for a while. But we're having those conversations, and that's what we're doing, Ian, today to make sure that in 10 years we actually can have a really great impact for the end user. And look, in 10 years, I better not be here. But there are people coming behind me in this business that are earlier in their careers, and they're going to want to be handed something that is relevant and sustainable. And so that's what we're working to. And it's no different for an end user customer that has a business and is operating trucks, or for a dealer, or for the OEM for that matter. We're all driving towards sustainability, certainly clean energy, and also just being able to make that transition sort of peacefully as it goes.
You know, it's just amazing, Kirk, to see the amount of interest and investment that's taking place in all these emerging technologies. And you know, we've been in since natural gas, pun intended, burst onto the scene, you know, several decades ago, in trying to understand the application, the adoption of alternative fuels. And so at ACT Research, we've done a number of studies on decarbonization. We're about ready to do our third one. And key or core to each one of those studies is actually a very sophisticated total cost of ownership model. Literally looks at every aspect of, you know, what it's going to cost to acquire, operate, and keep one of these vehicles on the road. And it becomes, I think, an indispensable tool for folks who are considering either on an evaluation basis, or, you know, who have made a commitment to, you know, to transition their fleets to a decarb solution. And so, you know, the challenge is the complexity of this environment, because, you know, literally it can be a lane by lane or even truck by truck decision as to, first of all, whether or not to transition to something other than, you know, today's incumbent internal combustion engine, or, you know, if it is, which flavor of alternative do you go to? And it seems like we continue to develop alternatives even on a recurring basis. You know, if you take all the different fuels and all the different combinations and permutations of those different fuels. So that's kind of how our decarbonization efforts have changed. You know, initially we benchmarked everything against diesel, and then we benchmarked against gas, and then natural gas. And now you're getting this matrix of benchmarking them all against each other to figure out, you know, where does this solution work and how can I employ it? And then, you know, subsequently what those adoption rates look like going forward, because you've got to have some degree of critical mass to get the infrastructure, to get the support, you know, the things that you were talking about, to keep these vehicles viable and on the road, and do it in a way that's going to, you know, benefit both parties, not just the equipment buyers, but the folks who are serviced by that equipment. So.
Yeah, and I think, you know, Steve, water always has its way of finding its way through cracks. And I think that for each of those solutions, those unique solutions, that, you know, they're going to find the pancakes. You know, where can we do this at scale and not get hurt and do something great for our customers? And it's going to happen in each of those, you know, those solutions that you mentioned. And it is going to be application centric. I mean, it just is. And they're going to find their way through those cracks to the pancake factory where they can scale it and then, you know, build it out from there. But that's really where it starts, is identifying the exact segment, the market, the application, where you can build your solution out, and, you know, partner with financing providers to get that and bring it to market.
Yep. So if that's something that any of our audience members are interested in, you can certainly contact either one of us to learn any more about the offerings that we have in each of those areas. Ian, any more questions queued up for us? Or we're probably nearing the end of our time together, I guess.
Yeah, probably coming to a close here. So yeah, I think we're back to the John Denver "Take Me Home, Country Roads" theme there.
Okay, well, that previous comment that I made stands for not just you know, efforts and initiatives as they relate to decarbonization. ACT is also studying autonomy, whole nother topic. We don't really have time to cover today, but if that's something that you're interested in, certainly feel free to reach out. One selfish plug that I would put in, I don't know if we have any upfitters or bodybuilders who are participating in our call today, but you know, there's just a dearth of information, unfortunately, in the commercial vehicle market. And one of the biggest gaps that we have is understanding more application specific metrics as they relate to the industry. So I would put out a call to any outfitters who might be on the webinar today. if you're interested in having a conversation about how you can provide data and help eliminate that knowledge gap, we would certainly love the opportunity to have that chat with you. And yeah, Kirk, any thoughts? Closing thoughts?
Yeah, look, we continue to keep our ear to the ground on developments, and we're certainly partnering with ACT and working with your team on the decarbonization effort, and as are many others. And I would just encourage everyone on the call to find ways to become educated about what's coming, and then to design solutions with people that are invested as you are in the process. And certainly, you can see from lender to lender, from OEM to OEM, from dealer to dealer, the difference in thinking and approach. And find people that are trying to figure it out and make it work and go there. That'd be my biggest takeaway from today.
Excellent.
Right. Well, thank you both.
I will say, I will say, we started out this call earlier today, and Steve and I were on the phone with Colleen, the marketing person there at ACT, and I was talking about Steve and I 25 years ago, thinking about doing a webinar over Zoom, in 2022, and she's like, I wasn't born. So, I am now officially the old guy in the room, and I'm okay with it. It's been good being together. And I appreciate everyone that has joined the call today, no doubt. And thank you, Ian.
Yeah, and thank you for initiating the conversation through the video series that you and your team executed. And we're glad that we can have this wrap up discussion here. And we did dive deeper into these topics, which is great. So if you are a guest with us today, we want to thank you for making the time to be with us and providing some of your time to us so that we could continue this conversation. Feel free to reach out to either ACT Research or the Mitsubishi HC Capital team to discuss more about how you can use data to help strategically plan for your business in 2023 and beyond. So thank you once again, and have a great start to the new year.
Happy New Year, everybody.